Thank you so much, Margaret. Really appreciate the introduction. Really excited to be here. First time in Wichita. Not the first time in Kansas, though, but first time in Wichita. And really had a great dinner last night with some colleagues. Really appreciate the time being here. As was highlighted sort of in my bio, I've been with JP Morgan for about 10 years now, working under our chief strategist, Dr. David Kelly. And really our role and goal on the market insights team is to see the present with clarity. And the way we do that is through publications like our flagship publication, Guide to the Markets. This is a little chart book that gets sent out to over 450,000 advisors. We have 7 regional global guides. So we have a guide focused on US, guide focused on Europe, Asia markets, and we truly have a global team with boots on the ground all over the world. And it's an incredible team in which we share a lot of information to get a sense of what's happening on the global economy, being able to have boots on the ground in China, boots on the ground in Europe, really understanding what's going on, I think is incredibly important, informative in how we think about the world. So I'm going to use a couple slides from our Guide to the Markets here to talk through how we're thinking about the broader economic landscape currently. Let's talk a little about tariffs and trade. Fortunately, I have to start every presentation talking about tariffs and trade because it is very much driving a lot of the narrative in terms of, are we seeing a recession on the horizon? Do we see slowing growth? Do we see fiscal potentially picking up growth over the course of 2026? So we'll talk about some of that as well. We'll spend some time talking about the consumer. I would say on balance, there's generally been a tale of two halves. You've had the wealthier individuals in the economy really benefiting from asset price appreciation, whether that be home prices moving higher, stock prices moving higher over the last 4 to 5 years. Whereas again, lower income individuals very much dependent on that job, right? Getting that paycheck on Friday, right? So we'll talk about some of what we're seeing underneath the hood from a consumer perspective, then spend a little bit of time talking about inflation dynamics and broader asset allocation. Hopefully we'll leave some time for some questions. I'm sure there will be some questions as we walk through. So first, this slide here looks at the average tariff rate on U.S. goods coming into the United States. We actually take this data all the way back to the turn of the 20th century. And you can see that generally speaking, over the last 100 years, tariff rates have gradually been coming down. And it's been more advantageous to do so, right? As the global economies become more interconnected, global supply chains have grown more intertwined, it's been beneficial to lower the cost of doing business. However, it's clear that the administration currently is taking a very, very different approach towards tariff policy. So one of our hardest working analysts, a young woman by the name of Mary Park, we actually update the guide daily, and she's updating our tariff estimate number every day as we're getting new announcements and we're getting new trade deals being struck. And right now, at least at the end of last month, our estimated tariff rate was around 20%, but we just saw an announcement of a lowering of tariffs, particularly on our largest trading partner, China. So we've gone from 145% tariff rates on Chinese imports down to 30%. There are a few carve-outs there, particularly with things like fentanyl products. And then China has lowered its tariff rate on U.S. exports from 125% down to 10%. Now that brings that roughly average tariff rate down to about 13-14% at where it stands today. The reason why I sort of walk through some of the numbers, it's clear that the administration, at least on a go-forward basis, tariff rates are going to be higher. There seems to be this baseline 10% tariff rate that's likely going to be applied across the board. What I'm getting at is we're not going to be stepping back into a world where average tariff rates are at 2-3%. Average tariff rates going forward are going to be likely between 10 to 15%. And that's obviously increase the cost of doing business for a lot of companies. It's likely going to increase costs for consumers as well. And this has created a lot of angst and uncertainty amongst consumers and businesses. We're not really sure how things are going to shake out. But again, we generally expect that prices and the cost of doing business, as I mentioned, is going to be higher going forward. And we're seeing this particularly in a lot of the survey data. When we say survey data or soft data, these are measures that sort of try to get a sense of where the economy may be headed. So this is our survey dashboard. The top left-hand side chart, we show services and manufacturing PMIs. Top right, we show business confidence, looking at both small businesses as well as CEO confidence for larger companies. Bottom right-hand side, we show CapEx intentions, so what are businesses' intentions on spending on research and development in that new property plant, as well as the housing market. And on the bottom left-hand side, we show consumer confidence. In earnest, a lot of these measures had already been rolling over since the start of the year. So confidence was generally starting to wane as we came into the new administration. And these numbers have continued to soften as we move through the first quarter and through April. In fact, consumer confidence is now at some of the lowest levels that we've seen going all the way back to the global financial crisis. So this is weighing, this is driving a lot of angst, and it certainly makes sense, particularly when you think about activity going forward. If I'm a consumer and I think prices are going to be higher 3 to 6 months from now, I may pull forward that purchase. I may try to buy that new couch today, or I may not make any purchases at all. I may pull back on spending altogether. We're seeing that particularly when you look at light vehicle sales, right? So light vehicle sales really surged in the month of March and April, people pulling forward that purchase of new cars. And it's likely that demand is going to wane going forward. If you're a business and you're uncertain about the business environment over the next several quarters, are you going to invest in that new property? Are you going to hire aggressively? Probably not. And so this is really informing our outlook in terms of, are we going to slide into a recession or not? It's still a very close call. I think there's growing optimism around new deals being struck, but a lot of the damage perhaps may already have been done. So we're very, very close in terms of our outlook for a recession. We're right at around 50%, maybe just below 50% of a recession. I know we've had a lot of recency bias, so when you say the word recession, you think double-digit rates of unemployment, pandemic recession, global financial crisis. But we actually think if we were to slip into a recession, it would be a relatively modest and mild recession. The reason being is you need to have sort of a cyclical boom in order to have a recessionary bust. Because confidence is sort of waned a little bit further, we're not seeing sort of any cyclical excesses in the economy that would lead to have a really big recessionary bust. And so again, we think the economy kind of continues to muddle along here over the next couple of quarters. Maybe we have a modestly negative quarter, maybe we have a modestly positive quarter, but very, very close to a recession. We generally do believe, though, that if the economy can get to the end of the year, we are going to be looking at fiscal stimulus potentially juicing up the economy as we look ahead towards 2026. There's this big, beautiful reconciliation bill, right, working its way through Congress. And it's not necessarily the extension of the Tax Cuts and Jobs Act that's going to be stimulative. We're already paying those tax rates currently. And so all the other little tax goodies that are being woven into this package that could be stimulative, things like reducing or eliminating the taxes on tips and overtime. I think it's legislatively difficult to remove taxes on Social Security, but there may be one-time checks going to senior citizens that's sort of woven into the package as well. On the company side, lowering of corporate tax rates, as well as potentially fully being able to expense domestic investment. All these are going to be net stimulative for the economy as we look ahead towards 2026, potentially bolstering growth. But I want to spend some time here to talk about what we've just experienced over the recent quarter. The left-hand side chart looks at real GDP growth in dollar terms, going back over roughly the last 20 years. And on the right-hand side, we show the components of GDP. To no surprise to anyone here, you can see that big blue box on the right-hand side. About 70%, almost 70% of economic activity is generated by the consumer. So the old adage, as goes the consumer, so goes the economy. The economy is very dependent on you and I going out and spending our dollars on goods and services to continue to move forward. Now, in the first quarter, interestingly enough, we had a contraction, modest contraction, down 0.3% quarter over quarter in the first quarter. A lot of that, though, was driven by two components, net exports and a decline in government spending. In fact, net exports, and this, keep in mind, this is the pulling forward of purchases ahead of higher prices. So companies really stocking up their shelves ahead of the expectation that prices are going to move higher. Net exports dragged GDP growth down by almost 5 percentage points in the first quarter. Net exports was the largest drag on history in the first quarter that we have data going back to 1947. So, and also government spending. We've seen a lot of cuts coming from the Department of Government Efficiency that also weighed on economic growth in the first quarter. But that big component there, consumption growth, consumption growth still grew by about 1.5% in the first quarter. Business investment still also grew by about 1.3% in the first quarter. So there's still domestic demand still in the economy, and it's very evident when we hear Chairman Powell talk that they're looking past some of the weakness in the first quarter because the trade numbers, again, are kind of muddling the picture in terms of domestic demand in the U.S. economy. So we don't believe this is portending to a recession necessarily. There's still risk to a recession, but even if we log a modestly negative quarter in the second quarter, we don't think that this would constitute a recession in the U.S. economy. And I mention that because sort of the back of the envelope definition of a recession is 2 consecutive quarters of negative GDP growth. But that's not necessarily what the NBR, the National Bureau of Economic Research, goes by. They actually track 6 indicators in determining whether the economy slips into a recession. The first, real personal income, less transfers, right? So how are real incomes growing or declining? Labor markets, so the household survey and the establishment survey, industrial production, real retail sales, and real wholesale sales. 5 out of those 6 components are still growing over the last 2 quarters. And so again, we very much do believe that we're not necessarily sliding into recession, but the risks are certainly still there. I want to spend some time on that, again, that roughly 68.5% consumption number, and talk a little bit how we're seeing the health of the consumer. And I would generally say that consumers are on a decent footing. But again, we do expect some slowing in consumption growth going forward, driven by the amount of uncertainty. Now, one of the big things, and if you kind of think back to the end of 2022, 2023, where a lot of economists, ourselves included, were calling for a recession. We believe that the Fed raising interest rates as aggressively as it had done in 2022 and 2023 was going to cause the economy to slide into a recession. And particularly higher interest rates weighing on overall consumer activity. But if you look at the top right-hand side chart, it's very interesting. This looks at debt service amongst consumer households. So how much of your income are you making towards your liability, your debt payments? If you look, interestingly, that number actually declined quite rapidly right during COVID. Obviously, part of that was the Federal Reserve cutting rates to 0%. A bigger piece of that was many consumers took the opportunity to refinance their largest liability item, i.e. their mortgage, at 2-3% interest rates. They also locked in a lot of those mortgages for the next 30 years. So those payments aren't necessarily changing, even if the Fed is raising interest rates. It's seizing up the housing market for sure, but it's keeping consumers in a pretty decent spot when we look at broader debt obligations as a percentage of income. This is a very different environment when we think about 2007. Over 30% of issued mortgages in 2007 had a variable rate. And so that rate was adjusting as the Fed had higher interest rates. And these were also, a lot of these were subprime mortgages going towards individuals that couldn't really afford that housing payment. Today, or back to 2020, over 95% of newly issued mortgages were fixed rate. So again, a lot of people taking that opportunity to lock in those very, very attractive rates. And that just meant that the feed-through effect of tighter monetary policy was a lot slower in terms of impacting consumers. I would also take a look at the left-hand side chart too. This looks at total assets, aggregate assets for consumers relative to total liabilities. It's been quite fascinating. If you were to wind the clock back to the fourth quarter of 2019, while currently, as of the fourth quarter of 2024, that number's at about $190 trillion worth of assets on consumer balance sheets. If you go back to the fourth quarter of 2019, that number was $130 trillion. So $60 trillion over the last 5 years of wealth has been created amongst consumers. That's a significant number, and I think that is generally helping to support consumers more broadly. And it's an important dynamic because I try to remind myself the top 40% of income earners generate 60% of consumption growth, right? So it really matters that this wealth has been created and that safety net has been created, helping to sort of generally support consumption. But there are some cracks starting to form, right? If you look at the bottom right-hand side, we tend to like to look at delinquency rates. So this is flows into early delinquencies. We're looking at auto loans, credit card loans, And student loans now have to start being reported to the credit bureaus as of the first quarter of 2025. So that number has actually started to normalize. But on balance, we are starting to see a bit of pickup in delinquency rates, suggesting that, again, consumers are coming under a little bit of pressure. I will say a lot of that pickup in delinquencies is driven by lower quality, lower income borrowers. There was a little bit of credit score inflation coming out of the pandemic when a large share of the population were on additional federal unemployment insurance. They were also seeing checks from the government. So what ended up happening is you start to get some FICO credit score inflation, and that allowed banks to increase the overall credit capacity that some of these borrowers were able to take out. A lot of that has more or less normalized, but when you look at some of these delinquencies, particularly across credit cards, that's a function of, again, some of these people maybe stretching their balance sheets a little bit too far. Now, I talked a little about the growth in assets. You talk about the 190 trillion. I think we have to be, very clear and understand that a lot of that wealth has accumulated to the wealthiest Americans, the wealthiest people in the economy. The right-hand side chart, this looks at the blue line, shows the share of income that is generated by the top 10% of earners in America. So you can see that in terms of all the income generated in the United States, if you go back to the 50s and the 60s, the top 10% accounted for about 35 or took home about 35% of that income. That number is now over 50%. And that's pretty important because when you look at the left-hand side, you can see generally that wealthier individuals spend in the economy about 50 cents of every dollar. The bottom 90% spend about 90 cents on every dollar. So very little capacity to be able to save, very little capacity to be able to invest. And so when we think about the increase in this overall income inequality across the board, this has also led to, again, those wealthier individuals investing into financial assets, not necessarily spending. And so if you look at the gray line on the right-hand side chart, this is the ratio of financial assets to GDP. It's fairly stable throughout the 50s and 60s at around 2.5%. Now that number is at about 4.5%. So as you start to see, and I think some of this was exacerbated by the Federal Reserve keeping interest rates at 0% for 15 years after the global financial crisis, that led to additional risk-taking. Folks had to step into financial assets in order to further increase their wealth because you weren't able to own bonds because they weren't kicking off any income for clients. So this is an interesting dynamic, something that we're watching. This has broader reaching ramifications on things like inflation, obviously sort of sentiment amongst the consumer population. So this is a dynamic that I think is interesting, but important as we think about consumption growth going forward and the ability for markets in general to continue to rally and move higher. Now, we sort of talked about some of the wealthier individuals and how they benefited from this increase in overall net wealth and this increase in financial assets. Obviously, the lower income individuals are very dependent, as I mentioned earlier, on their jobs. They're very dependent on getting a paycheck on Friday. This chart here looks at our labor market dynamics. The gray line shows the unemployment rate. Take this back over the last 50 years. The blue line shows wage growth. You can see they're generally pretty inversely related to each other. The lower the unemployment rate goes, the less available workers there are to hire, and so companies have to pay up to try to attract an additional worker. So you have this very tight inverse relationship between unemployment rate and wages. And this is generally still a healthy labor market. The unemployment rate is sitting at 4.2%. You've got wages running at 4%. In fact, April was the 29th consecutive month in which nominal wage growth outpaced inflation. So folks are actually experiencing real positive wage gains and have been for the better part of the last 2 years. Now, going forward, we do anticipate a modest move higher in the unemployment rate. Obviously, in an environment of slow paces of hiring, that could put some upward pressure on the unemployment rate, but not double digits like during the pandemic, not double digits like during the financial crisis. We think a much more modest move higher, similar to the modest recession of the early 2000s, where you saw the unemployment rate peak out at around 6.3%. We think the unemployment rate peaks out at around 5% in the fourth quarter of this year. So much lower kind of peak in labor market weakness. Part of that is a labor supply dynamic. The administration has taken a very hard stance on immigration, and that likely will limit the upward move that we've seen in the unemployment rate. I would also mention that generally where we're at in terms of labor market currently, companies aren't laying folks off, but they're not hiring either. Two measures that we look at very closely are claims data, so we can get a sense of how many people are filing for unemployment claims, and we get that number every week. Roughly, it's been running at about 200 to 250,000 initial unemployment claims every week. That's generally a very, very low number. There's always a natural sort of turnover in the labor market. When you look at continuing claims, so these are folks that are claiming federal unemployment insurance on a continual basis. That number has actually been moving higher. So that would suggest that the initial unemployment claims number means that low level means layoffs aren't happening, but continuing claims means that folks, perhaps if they are laid off, they're finding some difficulty getting hired again. And so there's this late cycle dynamic that we're currently in, and that could start to put some upward pressure on the unemployment rate. But again, we don't think that even in a modest recession that we'd see a dramatic spike higher in the unemployment. And that's really important, right? Because if people are hired, people are working, people are making money, people will spend. And that's a direct feed through, as we talked about, to broader economic activity and GDP growth. A couple more points that I want to spend some time talking about this is a hot button topic, is the federal finances. And, to be very candid, we are on an unsustainable trajectory in terms of the federal budget. The top right-hand side chart looks at the deficit as a percent of GDP. The bottom right looks at the debt as a percent of GDP. And then we show the CBO's forecast of where the deficit and the debt will go, assuming all the expiring provisions of the Tax Cuts and Jobs Act are extended over the next decade. On the left-hand side, we show another stacked bar chart that looks at all the sources of government spending, so where we spend, and all the sources of revenue, how much revenue we generate. Let me first talk about, obviously, DOGE, Department of Government Efficiency. They have a stated objective to try to cut government spending by $1 trillion this year. It's a very, very optimistic and perhaps unrealistic figure. If you look at the left-hand side chart, you've got net interest, about $950 billion. You can't cut net interest. Social Security, Medicare, Medicaid. If you look at sort of the components of the reconciliation bill, the Republicans have pulled out on making dramatic cuts to Medicaid. There's been some cuts to Social Security, not a whole lot. You've got defense spending. There's actually expected increases to defense spending in this reconciliation bill. And so you're generally left with about $950 billion worth of non-defense discretionary spending. This is spending on sectors like education, transportation, Veterans Affairs. We have seen some meaningful cuts there. Particularly, you're seeing a lot of federal grants and aid pulled from colleges and universities. That's going to generally make a few cost savings, although could, on the other end, increase education costs for folks looking to attend college. But generally speaking, there's not a whole lot that you can sort of trim from a government spending standpoint. When you look at sources of financing, there's also tax cuts that are still being baked in. And so actually lowering some of the sources of revenues. And you can see there, we continue to run a deficit of just under $2 trillion. So a few $1 billion of savings here and there is not enough to really fill the gap, given how high the deficits that we run. Now, from an investor perspective, the challenge that this causes is, what does this mean for interest rates? Because if we're going to continue to run higher deficits, we have to issue more treasury bonds in order to finance all those deficits. And more treasury bonds, more treasury supply to the market, when there's generally a global question mark on where that next dollars are going to go to the U.S. We're seeing some of our global clients kind of looking to put that next marginal dollar in Europe instead of into the U.S. And so there's a real challenge in terms of what this could mean for interest rates going forward. We're going to talk a little about fixed income markets a little bit later on. But we don't think this is a near-term crisis, but this is certainly a longer-term issue, 10, 15, 20 years down the road, where this is going to become a real concern. Very quickly on inflation, I forgot to mention that part of the reason that tariff revenues or tariffs are a feature for this administration is the amount of revenues that it's going to generate. Now, we got a bit of some numbers here, so we know how much tariff revenues and duties were collected in the month of April. The U.S. government collected just under $17 billion in tariff revenues in the month of April. So you annualize that figure, you get yourself to about a $200 billion figure in terms of tariff revenue. Again, we run deficits of just under $2 trillion. So cutting spending while increasing modestly some tariff revenue is not going to be enough to change the trajectory that we're on. This is also going to have a direct feed through to inflation. So this slide here looks at our inflation components, the big drivers of inflation. There's going to be some pushes and pulls on inflation going forward. So you've got these still a few components of inflation that are contributing an outsized share to inflation, things like shelter and auto insurance. Those components of inflation should continue to narrow going forward. Energy, interestingly enough, could continue to be deflationary as well. So OPEC Plus, they just announced increasing overall energy output, oil output by about 400,000 barrels per month. This is at a time where the IMF is lowering its global growth forecast. So increased supply, less demand, that could mean lower prices. So it may be more affordable to fill up your car on the way to work, right? So that's going to be deflationary on inflation going forward. This is going to be offset by inflation really feeding through core goods. Right? We talked about tariff rates on goods coming into the U.S. And increase in tariff rates are likely going to start to feed through core goods inflation. So we don't anticipate 9% inflation like where we're at in 2022, but we do think that in the third and fourth quarter this year, we'll see headline inflation peak out at around 3.5% to 4%, and we think core inflation peaks out between 4% to 4.5%. So modest moves higher on in inflation, but what this likely means is that the Fed perhaps can't cut rates as aggressively as folks would like or the market expects. So this is a dynamic that we're going to continue to monitor. I think the Fed is correct in maintaining a wait-and-see approach. Very quickly, I know we covered a lot. We talked about tariffs, talked about the economy, our outlook for a recession, very close call. If a recession were to materialize, we think it would be a very modest recession. Talked about sort of the increase in net worth and wealth that's been generated for the wealthiest Americans, and it's still a healthy labor market that's going to benefit lower income individuals as well. Talked a little about inflation, federal deficits, federal debt levels, and just generally there's a lot of uncertainty that's out there. I think we all generally feel this sense of uncertainty in the broader environment. But one thing we always say, the best defense against uncertainty is diversification. So this is a colorful slide. We call this our jelly bean chart. I'm more of a Skittles guy. This will be a Skittles page for today. But each of these boxes represents an asset class. And we track the total returns of all of these different asset classes going back over the last 15 years. So we've got REITs, small caps, emerging market equities, high yield, et cetera. That light gray shaded box that tracks the black line, this is a globally diversified portfolio, generally benchmarked to about 60% equities, 40% in fixed income, but truly a global portfolio. You can see that global portfolio is never at the top of this page. It's also never at the bottom of this page. It's always hovering right around the middle. And that's the point of diversification, helping to smooth out the ride for investors over time. You can see there, so far year to date, at least through the end of April, while it feels like we've had years worth of returns, both in terms of a sell-off in the market as well as a bounce back in the market, well-diversified portfolios are roughly flat to modestly positive so far on the year. So if you've maintained that diversification, you've maintained that steady hand, did not click the sell button, but stayed invested, you're doing okay. And I really want to thank you again, end on that point.